Doji Star, Breakaway, Inverted Hammer, Shooting Star, Hanging Man, and more. These are some of the names of the candlestick patterns that you should learn. The candlestick patterns indicates the future movement of the market, so it's very important to learn how to identify them. The more you practice identifying the patterns, the easier it will be for you to invest wisely and significantly increase your profit potential. The Japanese candlestick method was invented in the 17th century and was mainly used for trading in rice. The Americans copied it, and Charles Dow, founder of the Dow Jones Index, made a number of changes to it, but the basic principles remain the same. Due to their visual shape and color, Japanese candlesticks are the most useful indicators out of the three chart types used for technical analysis. Japanese candlesticks reflect the change in price over time. When looking at the diagram, we must first choose the time frame in which we would like to analyze the market's movement. We can choose time frames ranging from 1 minute to up to an entire month. Japanese patterns may include only a single candlestick or a series of several candlesticks, but no more than 5. Some of the patterns are meant to identify reversal points in the market, while others are intended to identify the continuation of an existing trend. In general, you can define the colors of the candlestick in each trading platform to suit your individual preference. Bearish candlesticks are usually red, whereas bullish candlesticks are green. To prevent confusion, from here on in, we'll refer to them using these colors. The following can be considered both bearish patterns, predicting a fall in market price, and bullish patterns, predicting a rise in market price. Doji lines, or doji candlesticks, are candlesticks which indicate that the closing price is equal to the opening price. These include 3 main types. Long-legged, these candlesticks have long shadows on both sides and indicate indecision on the part of the market players. Gravestone, the longer the upper shadow, the more bearish the outlook. Dragonfly, the longer the shadow, the more bullish the outlook. Bullish and bearish trading patterns. Shooting star. This is a reversal pattern that takes place over 2 days and indicates a bearish outlook. On the first day, the candlestick is long and usually green, supporting the major trend. The following day, the price opens near or slightly higher than the first candlestick's closing price and closes slightly lower, with a slightly longer shadow than the candlestick itself. Breakaway. This is a reversal pattern with 5 candlesticks and indicates a bullish or bearish outlook. In the bullish pattern, the first 4 candlesticks are red, falling, and the 5th candlestick is green, longer than the average, and closes above the preceding candlesticks. Harami. This is a 2-day reversal pattern that indicates a bearish or bullish outlook. On the first day, the candlestick is long and green and supports the major trend. The next day, the price opens a little lower than the closing price of the first candlestick and closes a little higher than the opening price of the first candlestick. 3 white soldiers. This is a 3-candlestick reversal pattern that indicates only a bullish trend. All 3 candles are green, with the second one closing above the closing price of the first candlestick, and the third one closing above the closing price of the second candlestick. The engulfing pattern is a 2-day reversal pattern and indicates a bearish or bullish outlook. In an engulfing minus pattern, on the first day, the candlestick is positive and supports the general trend. The next day, the price opens a little higher than the closing price of the first candlestick and closes a little lower than the opening price of the first candlestick. Engulfing plus. On the first day, the candlestick is red and confirms the general trend. The next day, the price opens a little lower than the closing price of the first candlestick and closes a little higher than the opening price of the first candlestick. Upside gap 3. This is a 3-candlestick reversal pattern that indicates a bearish outlook. On the first day, the candlestick is green and confirms the general trend. On the following day, the price opens at a price gap that is higher than the closing price of the first candlestick and closes green, meaning moving upwards. On the third day, the candlestick opens at a negative price gap and closes near the closing price of the first candlestick.